Thank you guys and welcome back to my channel today. We are going to be looking at financial assets at amortized cost. We've previously done compound financial instrument. We've done financial liabilities at amortized cost. Today we are going to do financial assets at amortized cost. So I take you straight to the material, then we look at it briefly for less than 5 minutes or so, and then we close out. When we say financial assets at amortized cost, you are simply saying that you are going to use the effective interest rate to allocate the interest or the discount element over the lifetime of an instrument, such that you are going to discount the amount back to the original amount of the asset. And we said previously that interest or transaction costs are added to the gross proceed of a financial asset, but they are subtracted from gross proceeds of financial liabilities, as we saw under financial liabilities. But for financial assets, you add any transaction or issue cost, but here we don't have an issue cost. We are just going to show how to amortize the financial asset over the lifespan of the asset. So the question is here simple. On 1 January 2011, Global Bank purchases a debt instrument for its fair value of 1,000. The debt instrument is due to mature on 31st December 2015. The instrument has a principal amount of 1,250, and the instrument carries a fixed interest rate, which can also be called the nominal interest rate, which can also be called the par interest rate, that is paid annually. The effective interest rate is 10%. How should Global Bank account for the debt instrument over the five-year term? Like we said previously, but even if you've not listened to the previous videos, that's not a problem. What I do is that I have two amounts, the fair value and the principal amount. The first amount that I bring forward at the beginning of the year is the fair value of the instrument, which is 1,000. Then I add the interest at effective interest rate to the fair value and subtract the interest at nominal interest rate from the addition of these two to give me the closing amount at the beginning of year one, and I continue the process until I hit the last year. And so what happens here? The interest at nominal interest rate is applied on the principal and not on the fair value. So normally when you're given the fair value and you're given the principal amount, you apply the interest payable or receivable on the principal amount, not on the discounted amount or on the fair value of the asset. So for year one, what do? We bring forward the par value or the amortized amount at the beginning of the year. I add interest at 10%. I subtract the interest receivable at nominal interest rate. I have 1041. Closing balance of the asset at year one give me the opening balance in year two. I apply the interest at 10% of 1041 is 104. I add it back and subtract the interest received. That gives me 1086. That becomes the opening balance for year three. And I continue the process until I come to the 5th year, and it brings me back to this principal. So for here is a financial asset. For financial asset, at the end of the 5th year, I expect to receive the interest plus the principal. Here, I could have just ended it on this other next column, but I had to bring this 1,250 here to show you that, the effective interest rate, we can also see that the interest rate that we use to discount the interest received or paid, such that we bring back the instrument either financial asset or financial liability to their initial carried value. So the principal amount of this instrument is 1,250, but it was discounted to a fair value of 1,000. But don't forget that the interest that I will receive as a buyer of the instrument will not be based on the fair value, but based on the principal amount. And the difference, this 250, is what we have been able to spread over the lifespan of these assets, such that we have been able to bring back this 1,250 to the original amount. A few things that I said already in financial liabilities at amortized cost, which I want to say here, is that the interest that goes to P or L is the interest at effective interest rate. For financial assets, we are going to be talking about interest received, interest receivable. So here, when you take it to P or L, it is going to come as a credit. If it was a financial liability, it will go as a debit. So if they ask you for year 3 is 104, year 4 is 113, year 1 is 100. So that is how to account for financial asset at amortized cost. You apply the nominal interest rate on the principal, and that is subtracted from the carrying value of the asset from year 1 to the end, and you apply the effective interest rate rather, on each of the balances of the asset brought forward at the beginning of the year. If they ask you what's the carrying value of the financial asset in year 3, at the end of year 3 is 1,136. Beginning of year 3 is 1086, which is like saying the end of year 2. So simply, that is how to account for financial asset at amortized cost. This will close the series on financial instrument at this level. We could be looking at a hedge accounting and other part of it and derivatives as we proceed. Thank you for watching this video. You can watch compound financial instrument and financial liability to build up on the other information that you need for the financial instrument series. I see you as I start series on the other accounting standard. Don't forget to like and the video and subscribe to my channel so that any new video you'll be able to see them. Thank you very much.